I'll get started now about 1:30, so I think we'll try to keep this on schedule. My talk is about Bitcoin, the asset maximalism, versus the idea of Bitcoin technology or Bitcoin, the chain maximalism. So this talk was inspired by Twitter drama, as many things are in this space. A lot of tweets coming from a lot of people in here, but prominently someone like David Bailey. He said, building on Bitcoin, native innovation on the assets, the native collectibles, these are all the things that Bitcoin can do now that the other protocols were doing before. It's just an obvious thing to support. So is that actually good for Bitcoin? A little bit background about myself. So I've been in Bitcoin since 2011, so I was a little bit of a late arriver to the space. I thought I missed the boat. So I've been around for a while. I've seen the narratives. I've seen the building. I've seen a lot of good things come out of it, and I've seen a lot of really dumb things come out of Bitcoin and things that people have wanted to build over the years. And back then, there weren't, altcoins to build on. So a lot of the worst ideas came straight to Bitcoin. So we got to see a lot of those things as we went along. I started writing a lot about Bitcoin in 2015, rather than just kind of following it on the sidelines. Big advocate for the USAF movement back then, and part of the fork wars when the drama was at its height. Led me to Blockstream back in 2017. I spent about 5.5 years there, both in through the product and research team, and now I've left Blockstream earlier this year to go to Synota, where we're building solutions on Lightning. So this is kind of been a long journey. All right, I'm going to touch on what is maximalism. What does it actually mean? What does it mean to be good for Bitcoin? Why does Bitcoin actually have its value? And then kind of talk into this idea of how these chain dominance versus asset dominance matter or not. All right, so what is Bitcoin maximalism? We need to really distinguish between two concepts: Bitcoin the asset and Bitcoin the protocol. So when you talk to different people about I'm using Bitcoin, I'm building on Bitcoin, it really kind of depends a lot of times on who you're talking to and what they're doing. And Bitcoin the asset kind of lives in many places. So you have the obvious place, which is on-chain Bitcoin. You have the idea that it's transferred right there, but Bitcoin can exist in many other places. You can have sneakernet-like designs where you have an open dime and you pass that to someone else. That's a Bitcoin transaction in the practical sense. You're transferring Bitcoin from one party to another securely, and it never touches the blockchain. It's not using the Bitcoin protocol in any way other than initially setting up that transaction. A lot of talk, layer 2 solutions are something that are really getting ground right now, especially as more usage of Bitcoin happens. So you have Lightning transactions. We have the idea of Arc coming out now. So these are different solutions to transact in Bitcoin that eventually will touch the blockchain, but for the most part do not in their typical use cases. Custodial Bitcoin, that's something that's been around since the very beginning, where you'll send your Bitcoin somewhere and they have an internal database and you can transfer back and forth between people, and as long as they don't rug you or they don't get hacked like Mt. Gox was, or Wolf, or they don't lose their keys or anything like that, you're in good shape. But if they do, then it's not really your Bitcoin anymore. But this is still a very popular type of exchange of doing it. So exchange to chain transfers will do this. I would put Fedi in this category, Cashew, all those types of eCash. They're holding Bitcoin. They're giving you some type of IOU, and it's just transferred, not a database in this case, but it's some centralized service. Then we have the idea of like a custodial blockchain way to hold Bitcoin. And so something like wrapped Bitcoin on Ethereum, that is a way that you send your Bitcoin in, they give you a token on some other blockchain, and you can go do with it whatever you're wanting. Now as long as this thing is honest and run well, there is supposedly one Bitcoin backing it for each one of these. Because it's cryptocurrencies, you can usually prove that pretty easily. So you put things in this bucket. Wrapped Bitcoin's the biggest one. There's wrapped Bitcoin on like every chain, it seems like. Liquid Bitcoin, Rootstock with their RBTC token. Something like Drive Chains, where you're, instead of having a set of fixed participants, you just are having the miners do this to take custody of your Bitcoin. And then you can have things like derivative contracts. This is where you're getting exposure to Bitcoin, the asset, but you're not actually, there's no Bitcoin ever involved. So like the CME, if you're trading Bitcoin futures, it's all cash settled. It's just betting on whatever the price is going to be, but you can still get in that market if you want to have exposure to Bitcoin, the asset. And in that case, you never touch the protocol. There's no Bitcoin that is ever even involved in such a transaction. And then you have the Bitcoin protocol. And this is a technology layer that was originally invented to transfer Bitcoin on-chain. But it can be used for many purposes, and it has been over the years. So we have the idea of like metadata can be put onto the transactions to mean other things as well. So counterparty and Omni, or Mastercoin as it's formerly known, Ordinals now. This is a way to embed data and take external meaning that normal Bitcoin nodes don't care about or don't know about and give it extra meaning. And they can be used to transfer any asset, in this case, using the Bitcoin protocol. And you have data storage and commitments, so inscriptions, storing them. We had a panel in here earlier about the idea of inscriptions and how that worked. Open timestamps, this is committing to data. It doesn't actually store the data, but it does something useful, like being able to store that it happened at a time. Taproot assets and RGB, these are things that commit to the data on chain to make sure it hasn't changed, but it doesn't actually store the data. All right, so asset maximalism, if you're not familiar with the history of the term Bitcoin maximalist, it was actually coined by Vitalik of Ethereum fame, and it was meant as an insult to Bitcoiners. So it's the idea that in an environment of multiple competing currencies is undesirable and is wrong to launch yet another coin. And that it is both righteous and inevitable that Bitcoin, the currency, comes to take a monopoly position in the cryptocurrency space. And so this viewpoint, there is a moral component to it that he's saying, that it's wrong to do it. But the Bitcoin maximalist idea kind of spread as like Bitcoin is inevitably going to take over as, in this case, he's saying just cryptocurrency, but even could take on the view of all money in the world. So that is the extreme Bitcoin maximalist position, that Bitcoin will win. You don't have to be in favor of Bitcoin to be a Bitcoin maximalist. You can think it's inevitable that it will win, and that's a terrible idea. And there are a couple of people I've heard that actually think that. And then this new term is something I made up called chain maximalism, and I just replaced the word another coin with another chain and blockchain in there. So the idea is Bitcoin, the protocol, it will win, and everything will migrate to the Bitcoin protocol that can. And that there's no reason to ever have any kind of blockchain-y like thing out there for storing your assets or doing any other purpose that you might be doing other than on the Bitcoin protocol. All right. So what is good for Bitcoin? And this really comes down to who you ask. So I stole this slide from Giacomo Zucco, who is much better at delivering this message than I am. So I highly recommend looking for this talk on Bitcoin cultures. And really, there's not just one set of what is a Bitcoiner. So you really have kind of three circles in here. He's measuring idealists, engineers, and speculators. And they do overlap. So some people may live in, just like any Venn diagram, they could be in any part of it. They might be in, outside of the circle. But he's also focuses a lot on people that intersect some of these places. So you have on the left side of idealism and engineers, the cypherpunks. You have the engineers and speculators, the starter-uppers. They don't really, they're just trying to build something that's going to get users and make a lot of money. It's fine. You don't have to share the ideals of Bitcoiners to use it. I said Bitcoiners like that's a one thing there. There's a little slip there. I think you have the idea of maximalists. So they're really speculating on the money and believe Bitcoin's going to win in terms of a monetary thing. And you can live in the middle as well. So I mean, I feel like I live pretty close to the middle of this diagram. So what's good for Bitcoin really matters who you ask. So the cypherpunks, what they care about is, can they use the tools that Bitcoin provides and tools that are on top of it to evade overreaching governments and corporations, right? Like they're trying to maximize freedom in this case. Now the maximalists, the traditional maximalists, they're looking at number go up. They believe Bitcoin is the future. You have the kind of short-term speculators who are kind of like number go up right now, and then you have the like hardcore Bitcoiners that are maximalists that are saying, I'm trying to build wealth for generations through here. So there's a wide range of time preferences in here, but I think you can lump all of those in that maximalist bucket. And then you have the starter-uppers. They're looking for use cases in building. So if you can do cool things on Bitcoin, even if it has nothing to do with Bitcoin, the asset, this is good. Like, I should do it. And that's what they're going to be most interested in. And if you can build tools that do that, you're going to be really excited. And if it gets hard for you or the fees go up or it just doesn't work, then Bitcoin's broken. So looking at what gives Bitcoin value, this is more in terms of a monetary thing. We're going to do a quick economics review. Just kind of the idea of the pricing theory of money And the idea is, money is there's going to be a quantity of it, and it's going to move so fast through the economy, and that's going to kind of total the total economic activity that's going on. So in the Bitcoiner world, we're kind of relate this way. Every asset in the world has to be owned by someone at some point in time. And that may be something that passes very quickly through the economy. So when you're in a country that has hyperinflation, everyone is trying to dump their money on everyone else as fast as possible. You want to spend that money as soon as you do. So if you go to a restaurant in like somewhere like Argentina where the money's falling apart, you might pay for every course of your meal individually because the price changes between each course. And so you're trying to hold that money as little as possible. So in this case, we're going to compare the hodler who buys a Bitcoin. And in this case, he's kind of a weak hodler. He only holds it for a year, but it makes the example easier. I'm going to get 100,000 onboarded users to the best coffee buying app ever. They hold dollars, but it just converts it to Bitcoin, and it will send it to the coffee shop when they want their coffee every day. And then the coffee shop doesn't really care for Bitcoin, so they're just going to transfer it back to dollars and go on their way. And I'm assuming this app is really inefficient, and it takes 10 minutes to do that. And you're going to think, what actually is going to push the price of Bitcoin up faster? In this case, what's going to have more impact? If you're one of those Bitcoin maxis that wants the number to go up, who's better for you? And looking at the numbers and looking at this, I'm calling this hodl power index. How much Bitcoin are they taking out of circulation for this to work? The hodler is pulling 1 Bitcoin off for a year. That's pretty obvious. When you do the math on the 100,000 app users, they still can't even match that one hodler. So when you're onboarding users and saying, oh yeah, we're going to onboard 1 million people and they're going to use Bitcoin to do some activity, if they're just passing through, it really doesn't push the needle very far. You need to onboard a ton of people for that to matter. So that needs to not just be the whole story, at least to make Bitcoiners who care about the value of Bitcoin to really care about it. So I'm going to kind of dive in through some of these use cases that are out here, present my attempt at a steelman argument for why they're good for Bitcoin, and then kind of the counterexample of why those theses might fall apart. So do these non-Bitcoin use cases drive Bitcoin asset adoption? All right, so stablecoins is the big one. You think of anything that's going on in crypto right now, a lot of people are excited about this. You talk to any VC firm that's interested in this, stablecoin is the thing that they are going to be really excited about if they're not Bitcoin maxis. And fact of the matter is, the USD is the biggest shitcoin in the world. It is the best shitcoin in the world, and everyone wants it. Because Bitcoin is very volatile, and not everyone has the patience. They don't have the, they can't withstand the swings of Bitcoin over the price of the time, and they don't have the ability to save for the long enough time for that to be a more stable investment. So they would rather kind of sit on a slowly melting iceberg than try to worry about trying to go through a storm. So that's okay. I totally respect people that want to have exposure to USD. I have some. I'm lucky. I'm in the U.S. I can open a bank account. A lot of people around the world don't have that luxury, and they can't get access to dollars, and that's a problem they have. And there's a lot of people wanting to solve that, and they've solved that, through dozens of blockchains that have access to stable coins. There's algorithmic ones. There's ones where it's backed by a certain asset that can work as long as the asset's stable. If you back it on Terra Luna, it doesn't work so well. If you back it on Bitcoin, it might work for a while. If you back it on the actual US dollars in a bank, it might work until they get rated. So there's lots of ways, this could theoretically work, and in practice, you're working for a while. And the counter argument, so the thesis is, why is this good for Bitcoin? All this investment if they're building this on Tron, that doesn't help Bitcoin at all. If they start building this on Lightning or just other protocols of Bitcoin, that's going to bring a lot of investment into this space. That's going to bring a lot of developers in this space that will be building out this infrastructure that will be reusable once everyone wakes up and realizes Bitcoin's better than the USD. And that's kind of the steelman argument for it, that it's going to bring a lot of attention for it. And I think this is probably the strongest one I've seen in here. But it also comes with a major risk and downside. And that is, if you're trying to make Bitcoin win, and you care about wanting to make Bitcoin win, and you make its biggest competitor stronger, that's a big risk. You might make the dollar just good enough that Bitcoin can't cross that needle to get that adoption of the users and get the hodlers and get the people who make their unit of account in Bitcoin. All right, so the next one for stablecoins, it's the same idea. The thesis behind it is, well, okay, they're gonna get involved in stablecoins, but they're gonna dabble a little and try to hold some asset, some cryptocurrency asset, because they think that's gonna go up in value as well. And they got a little bit of room for saving, but not a huge appetite for it. So if I buy Tether on Tron, like, well, that means I probably should just buy some Tron too to kind of screw around on it. And if we got those users instead on Bitcoin, and it was really easy for them to kind of go from having USD to having Bitcoin. Well, we can onboard people slowly, and then they'll eventually start saving more money, and they'll realize that's a good idea, and then we'll onboard more hodlers into Bitcoin. And the argument for that is, like, Bitcoin pegs exist on like every chain. Like, you can get wrapped Bitcoin pretty much anywhere that exists. And yeah, it's not as pure. It's riskier in that you have to trust a custodian to hold it, but they are still holding Bitcoin. And so the really, we can onboard subpar Bitcoiners that are not holding their own keys and doing things like that onto all these chains, but it also is moving the needle in the right direction, having those wrapped assets denominated in Bitcoin. The fact that like wrapped Bitcoin has tons of Bitcoin on it, like that's good for Bitcoin. That means like they don't want Ethereum. They want Bitcoin, the asset, to have that. All right, so drive chains. This has been another talk that's come up in here. Like, we need drive chains. We need to have all these blockchains and things like that to benefit Bitcoiners, because we actually will build all these use cases that are on all the alternative chains, and we need to kill those chains off and have the same chain but with a Bitcoin token on it that's maybe a little bit better, possibly, or possibly worse, depending on if I'm asking Peter or not. That will holding those Bitcoin be good for Bitcoiners, and it also is just kind of more natural fit that they might feel. It's kind of same arguments as the stable coin. And this is my counter argument right here. These are the two biggest side chains right here in existence right now, and you can kind of see the activity level is not great, as Ben mentioned earlier. There's really not much activity. There's not much demand for it. So we've got like 3,000. I mean, it's like a total of 6,000 Bitcoin between them, which is not better. I'd be happy if I had 6,000 Bitcoin. But the numbers on Ethereum for wrapped Bitcoin are 180,000. So you've got a map factor of 30 times bigger. So that's kind of like, this hasn't been an attractive proposition to be closer to Bitcoin for people doing this. They want to be closer to the suckers. All right, so drive chains, the kind of counter argument is like, these things already existed. Drive chains is still just another custodial blockchain, and that's just not what's keeping people from coming. All right, NFTs and inscriptions. So what the idea, and this actually came, this thesis, if you don't like it, came from someone else, but I do agree with it. But this came from like why Bitcoiners should care about NFTs even if they think they're garbage. So the NFTs will attract all these normies. They'll come in here. They'll try to get rich. Most of them will get wrecked. A few people will like make out really well and dump it on retail, and they'll be rich. And those people will, for whatever reason, decide that they're going to take all their profits and put them into Bitcoin, and if they were doing that on Ethereum, they would just take that and hold all their profits in Ethereum. But if they do it on Bitcoin, they're going to go buy them and keep them inside of the Bitcoin ecosystem. Again, this is kind of the same argument of what we had right here. Like, these pegs already exist on these chains. If these people were really interested in holding their profits in Bitcoin, it is incredibly easy for them to do this. Maybe they already do, and they just keep it in this wrapped Bitcoin, and they can kind of trade in and out of it. It's meant to be pretty frictionless to be able to make these exchanges and kind of go between these chains. All right, stocks and other securities. So we need a stock market based on Bitcoin. So we're going to put all the stocks on Bitcoin, or like a layer of Bitcoin or a side chain of Bitcoin. And then they'll just like all decide, like, instead of pricing like GE stock in dollars, they're going to price it in Bitcoin now because it's like happens to be on this chain. Yeah, that's not, I'm assuming everyone who's had that position has like never met anyone on Wall Street. So they don't want Bitcoin. It's toxic to them. They want nothing to do with it. They kind of, they'll be interested in the tech, but they start like, well, how do I get a USD version of this? So that's exactly what they're wanting here. Is like, this is not going to move the needle one bit on doing this. They want the technology, and it really at that point has nothing to do with Bitcoin and doesn't drive any value there. I guess I will go back and kind of cover all these use cases. The value that they do drive to Bitcoin in this case is they are paying transaction fees on a lot of them. And that transaction fees go to miners, which in theory gives more security to the network, depending on whether it's making the network more centralized or not. But that's also making Bitcoin less usable as a layer 1 technology, and even the layer 2s become challenged by having this fee environment. So I'm not going to use the SB words that get used in here because I think it's loaded and completely centralized planning. There's no right amount of fees or mining revenue out there, and mining is a race to the bottom, and it's going to be at the marginal levels. And just because there's more money in there, we do need enough to pay for adequate security, but there's no real answer of what that actually is. All right, DeFi. So this is something that captured a lot of interest in investments in other chains. All this DeFi stuff exploded. They all got onto Ethereum or Solana or whatever else is going on out there. And we just missed the opportunity to onboard all these users into Bitcoin. And that's just really an opportunity that we could have had. And again, this comes back to the same ideas, they have wrapped Bitcoin there as well. But it's also why, DeFi is mostly, it's mostly about how can I dump my illiquid tokens onto a market and encourage people to have them by giving them another token that I can dump on the market. So it's just really not just a speculator's game that will eventually die out in that sense. It's not adding any actual value there. All right, so this really comes down to, I'm kind of wrapping up here as well. You have the two different viewpoints here and I've heard this on panels here as well. The more on the speculator and idealist side the more you see that Bitcoin is money and that's what you care about. And the further you get away from that and you're more on the engineer side or the starter upper side of this one, you're really looking at Bitcoin as a payment technology. And the part that there's a Bitcoin asset on there is just incidental to that. So that really drives kind of that divide. And I think this is important. There's a lot of debate and arguments because it's I thought you were supposed to build all the thing on Bitcoin. Well, these are different people talking, and this is where they're, they care about different things. And there's not to say one's right or wrong. You can care, Bitcoin is a payment technology, and if you're going to build things on it, it better be the best way possible to do it, or else you're going to lose. Your reason for building on Bitcoin shouldn't be because you're trying to have purity or trying to maybe you can make an argument that there's Bitcoiners won't touch that stuff and you can have an opportunity there. But you need to actually be better in the tech side of that. And there are things that are massively better on the tech side by doing it. Open timestamps, I think, is probably the best example I can think of. It's great tech. It embeds it in Bitcoin. It doesn't cost hardly anything to use. You can scale it infinitely. It's super easy to throw that on there. So that's a good example of something to build on Bitcoin. But over the years we've seen a lot of really, really bad things. And when I say bad, I mean they're going to get priced out. They're going to be inefficient. We saw over the years, it was the Satoshi's Dice was a good example of that. Sending transactions on chain to gamble pennies and get pennies back. That got priced out. They complained, Bitcoin's broken. Well, you're just going to lose if you're not missing what are Bitcoin strengths and weaknesses as a protocol level. The Bitcoin protocol level is extremely inefficient for just about a large majority of use cases, except for transferring Bitcoin in a way that makes it uncensorable, unconfiscatable, and impossible to shut down. So that's kind of what it was built for. If your application doesn't kind of fall into those buckets, it may have challenges in that area. Now, there's a lot of things on top of Bitcoin and layers on top of it that you might have a chance. Really just make a good look. Make sure it actually is going to be superior technology for what you're doing. There's a lot of more stability in Bitcoin with a lot of things, and I can see why you're wanting to do that instead of blockchains that are maybe less stable to go out there. So that's all I had. If you have any other use cases or questions, or you kind of want me to shoot down your steelman arguments, I'm happy to troll people here as well. So yeah, thank you. Yeah, I think it's yeah. So the spot ETF, why is it not getting approved? I think only the SEC is going to really be able to give that answer on that one. They really Bitcoin. The U.S. government benefits greatly by having a lot of dollars export to overseas and things like that. So having Bitcoin as an alternative, a little bit conspiracy theory that that's on their radar and things like that. Like the Fed is very, very, very aware of Bitcoin and all of the layer 2 technologies and stuff. Like they're in the know. I was really surprised. But why is it not approved here? SEC is just going to be very conservative in general, and things just are slow to approve. And then we also have hostile regimes as well that are like very against Bitcoin and crypto. So I think it would be great if it could be. I think it would be very good for Bitcoin. I know there's a lot of people that are worried that the more stuff that gets under like corporate or like easily controlled by the regulators, that's a risk to Bitcoin. No matter how much is under anyone else's control, it's not proof of stake. They're not going to steal mine. So I'm not worried about it in that sense. Yeah, so the danger in the futures market, and this is kind of a big danger in Wall Street in general, is a lot of this stuff is trust based and running on credit and like hope things don't blow up and hope there's not the black swan event that's going to wipe everyone out. And then if it is, just hope to get bailed out. When you bet against but when you bet on a lot of these traditional commodities and things like that in the futures markets, it's easy to kind of correct the system by printing dollars or printing something to solve it. There's only 21 million Bitcoin, and if someone can't deliver a Bitcoin and it's actually physical delivery, you're going to get in a world of hurt, because it's just going to cause the price of Bitcoin to go up more and cause more of these problems where no one can deliver it. So that's if you are betting on Bitcoin futures, make sure it's actually there. Don't do the like trust-based ones or like cash-based collateral type things. Yes. Yeah, so it's going to be depends on if it blows up or not. So if it's in a stable situation and they don't issue too much of it, it may be more isolated even if it blows up. These things, it is good for Bitcoin in the short term that people are locking up collateral as Bitcoin, and that's basically going to that HODL factor of it's storing Bitcoin for someone's owning that Bitcoin, and it's being used just basically to give someone a stable USD value, and someone else is leveraging along the other side. But then we've seen, like we saw it blow up with Luna, where the collateral underneath has to be sold, and people are getting wrecked, and it's going to crash the market in that case. And so it can blow up and affect the broader ecosystem. Obviously, if you're just holding the Bitcoin, it's still one Bitcoin, but you might care if that's worth less than it was before. So that's something to watch out for. And Bitcoin still has been very volatile, no matter how much you over collateralize these things. And especially the more people get involved in them, it might not be enough, and that's something that can kind of set off a big wildfire of liquidations. That's risky. So I'm a little bit more simple-minded in that, like, if you're going to have a dollar stable coin, it's probably better to just have an actual dollar somewhere. But that also kind of gives you the risk of, like, it's very easy to just tell those people, that one central party could go and say, those dollars are not yours anymore. So that's also a risk. So really kind of pick your poison. I'm not a huge fan of stablecoins unless you have no other options. All right. Well, one more. We got 1 minute. I'll go quick. Yeah, I mean, we have 100 million Satoshis per Bitcoin. That was kind of an arbitrary choice of his. I don't know if he should have done it without it from the beginning, but that's like a design choice. So they can go pretty far down. I think we have to be like at like $10 million per Bitcoin before we even break the USD, the penny peg. Penny is per Satoshi there at that point. So it's a $1 million coin. Sorry, I was just a little bit off. We might get there, but the penny's also pretty worthless right now too. So I mean, we could probably go 5 times that and not really have a big deal. And there's millisats on Lightning and other ways to do that. And yeah, that was actually my biggest fear early on, was that like, why can't people just, they'll feel like they didn't get in early enough, so they'll just make their own coin. And then how do we get people to unify? And we got to see a lot of that in 2017, where everyone wanted to make their Bitcoin Gold and Bitcoin Platinum and Bitcoin Uranium and Bitcoin Gold Cash and Bitcoin SV and Bitcoin SV ABC, and they're all like dead. So it's pretty easy to see like that doesn't work. And so for hopefully people learn their lesson on that one and don't try it again. But if they do, I'm happy to sell them for more Satoshis. All right, I think someone else is up next, so I will step off the stage. Thank you.